Hi, thank you for tuning in to today's Emerald Gem, which stands for Get Educated in Minutes. I'm Dolly Donnelly, Director of Wealth Strategies for Wilmington Trust, Emerald Family Office and Advisory, and your host for today's podcast. In today's Gem, I'm going to answer the question, what is an irrevocable life insurance trust, and when should I consider using one? Before we turn to discuss personal life insurance trusts specifically, let's briefly review common reasons why high net worth and ultra high net worth individuals own life insurance policies to help frame their importance. At the most basic level, purchasing life insurance is intended to mitigate risk occurring from death. While the type of risk to be mitigated can vary depending on factors such as a person's stage in life or financial situation, common risks that life insurance is designed to mitigate include replacing income in the event of a premature death, ensuring that there is a legacy for heirs, and providing a source of liquidity for the payment of estate taxes. Now, for those focused on the last of those risks, providing a source of liquidity for estate taxes, it can be particularly beneficial to consider using an irrevocable life insurance trust to own their life insurance policies. Those who fall in this category often include owners of closely held businesses, whose estates may not otherwise include sizable liquid assets. In the absence of sufficient liquidity at death, high net worth and ultra high net worth business-owning clients potentially could leave an estate tax burden that has to be satisfied through a sale of the business under less than optimal conditions in order to raise the necessary funds for taxes. While mitigating the risk of estate taxes may be an issue for less individuals following the enactment of the One Big Beautiful Bill Act, or OBBBA, which permanently increases the federal estate tax exemption to $15 million per person, adjusted annually for inflation, beginning in 2026. For the ultra high net worth and those who live in states with lower state estate tax exemptions, the potential need for liquidity to cover estate taxes remains. So with those considerations in mind, what is an irrevocable life insurance trust? At the most basic level, an irrevocable life insurance trust, often referred to as an ILIT, is a type of trust designed to hold life insurance policies so that upon the death of the trust's creator, also known as the trust grantor, who usually also is the insured, the proceeds of the life insurance policies are not included in the grantor's taxable estate. Now, in contrast, in the absence of an ILIT, when a life insurance policy is owned by the insured individually, the proceeds payable on the insured's death are includable in that person's taxable estate. This essentially results in the proceeds, which were intended to be a source of payment for the estate taxes, further increasing the amount of estate taxes owed and reducing the benefit that they were intended to provide. By way of example, with the highest marginal tax rate for federal estate taxes remaining at 40% in 2025, that has the possibility of leaving only 60 cents for every dollar of life insurance benefit available for the payment of taxes. On the other hand, when held in a properly structured and administered ILIT, none of the death benefits payable on the trust-owned life insurance policies are subject to estate taxes. As a result, for high net worth and ultra high net worth individuals with taxable estates, the use of a properly structured ILIT to own life insurance policies can be an important way to ensure the proceeds truly are there to pay estate taxes, rather than adding to your estate tax burden. To achieve those benefits, the ILIT must be properly structured and administered. Like many other types of irrevocable trusts, an ILIT must be structured so that trust assets are not deemed to be included in the grantor's estate. This means that the grantor should not have the right to change or terminate the trust, and the grantor must relinquish control over the assets contributed to it, such as the life insurance policy. Consequently, in addition to having the trust own and be the beneficiary of the policy, the grantor should not possess incidents of ownership over the policy. For example, the grantor should not have the power to change the policy's beneficiaries, surrender, or borrow under the policy. The grantor also should not serve as trustee of the ILIT. An additional provision that often is important to include in an ILIT is called a crummy withdrawal right. Crummy in this context isn't a comment on the merits of the provision, but rather the name of an important case that provides a path for allowing contributions to be made to a trust to qualify for the contributor's annual gift tax exclusion. These provisions can be particularly important in the case of islets, so that the grantor can make use of his or her annual gift tax exclusion, $19,000 per person annually in 2025, to contribute money to the trust to be used towards premium payments. In order for a gift to qualify for the annual gift tax exclusion, the gift must be deemed a gift of a present interest. In most trusts without crummy withdrawal rights, the beneficiaries of the trust don't have a present interest in or an immediate right to access the funds contributed to the trust. As a result, contributions to such trust wouldn't qualify for the annual gift tax exclusion. Instead, a crummy withdrawal right is a provision that results in specified beneficiaries, the withdrawal right holders, having a present interest because they have the right to withdraw contributions made to the trust for a limited period. That said, despite having the legal right to withdraw the contributions, there often is an expectation that withdrawal right holders typically would not actually exercise such rights. Crummy withdrawal rights generally can be given to trust beneficiaries with current income or vested remainder interests in the trust. While crummy withdrawal rights can be a powerful tool for funding premium payments without using the grantor's lifetime gift exemption, there are additional requirements that come along with such rights. Perhaps most importantly, the trustee will need to provide holders of crummy withdrawal rights with timely written notice of contributions to the trust and keep sufficient documentation that such notice was provided throughout the period the policy exists. In cases where a grantor does not have enough crummy withdrawal right holders and associated annual exclusion gifting available to fund the payment of premiums, other strategies can be used to pay policy premiums. These may include using some of the grantor's lifetime gift tax exemption to seed the trust with funds or income-producing assets to be used to pay premiums, as well as evaluating the policy itself to see if there's any built-up cash value that could be applied towards premium payments. Care also should be given in deciding what type of life insurance policy to hold within an ILET. First, if thinking of transferring an existing life insurance policy to an ILET, it is important to note that the requirement that the insured survive 3 years from the date of transfer to the ILET. Otherwise, the proceeds of the policy will be included in the insured's estate. Additionally, for married couples, it may be advantageous to consider purchasing a second-to-die policy rather than policies on each spouse's individual life. Because estate taxes are not payable on assets left to a surviving spouse, most well-planned couples will not need to pay estate taxes until the death of a second spouse. Policy benefits and costs also can vary depending on the type of life insurance policy purchased, from term to permanent policies, and varieties within permanent offerings such as universal and whole life policies. Regardless of the type of policy ultimately chosen, policies should be routinely monitored to ensure that they are performing as intended. Additionally, for those who have existing policies, but whose taxable estates may fall below the federal estate tax exemption following the enactment of the OBBBA, this also may be a good time to review those policies to evaluate whether they still meet your needs or whether an alternative policy may be preferable. As with other trusts established for the benefit of heirs, an ILET that directs the proceeds of a life insurance policy to be held in continued trust for the benefit of a spouse, children, or future generations may provide increased asset protection, preserve family wealth, and help pass along the legacy desired by the grantor. Thanks again for joining us today. Please contact your Wilmington Trust advisor if you have any questions about irrevocable life insurance trusts or when to use one. We would be glad to help you. See you next time.
This podcast is for general information only and is not intended as an offer or solicitation for the sale of any financial product, service, or other professional advice. The information in this podcast has been obtained from sources believed to be reliable, but its accuracy and completeness are not guaranteed. The opinions, estimates, and projections expressed are subject to change without notice. Wilmington Trust is not authorized to and does not provide legal, accounting, or tax advice. Our advice and recommendations provided to you is illustrative only and subject to the opinions and advice of your own attorney, tax advisor, or other professional advisor. Diversification does not ensure a profit or guarantee against a loss. There is no assurance that any investment, financial, or estate planning strategy will be successful. Past performance cannot guarantee future results. Investing involves risk, and you may incur a profit or a loss. Investment products are not insured by the FDIC or any other governmental agency and are not deposits of or other obligations of or guaranteed by Wilmington Trust, M&T Bank, or any other bank or entity and are subject to risks, including a possible loss of the principal amount invested. Wilmington Trust Emerald Family Office and Advisory is a registered trademark and refers to wealth planning, family office, and advisory services provided by Wilmington Trust N.A., a member of the M&T family. Wilmington Trust Family Office is a service mark for an offering of family office and advisory services provided by Wilmington Trust N.A. Wilmington Trust is a registered service mark used in connection with various fiduciary and non-fiduciary services offered by certain subsidiaries of M&T Bank Corporation. Copyright 2025 M&T Bank Corporation and its affiliates and subsidiaries, all rights reserved.